Many of you have asked me for my opinion on Oracle stock. The stock just reported earnings. It's down 11.5% in the after hours. It's really, really bad. Down more than 32% from its all-time high. And I like Oracle. I like the report. It was a good report in general. But I'm also bearish on the company, mainly on their debt obligations, their balance sheet, and their strategy. So I'm going to do a deeper dive on the risks with Oracle and talk about the upside potential and my thesis in general. So I really hope you enjoy it as always. Now, this report for Oracle, I think it was really good. They got 226 in earnings per share versus 164 expected. That was a massive, massive beat. They did slightly miss on revenue. It was a tiny miss, nothing too crazy, but the market overreacted and the stock is down 11%. But in terms of performance obligations, which is their most important metrics, and you can think of performance obligations like their backlog for their cloud business, you could say. This is a measure of contracted revenue that hasn't yet been recognized. It soared 438% to $523 billion. And you could look at this chart and see the magnitude of the ramp up in their Oracle Cloud backlog from 137 billion 455. Now it's 523 billion dollars, and the market cap is like 600 billion. So they're almost trading at one time their backlog. This is absolutely insane for a company like Oracle, and the ramp up has been magnificent. But there's a lot of risks with this ramp up and with all those numbers and with Oracle in general. The biggest risk is from OpenAI, which has committed to spending more than $300 billion on Oracle infrastructure services over the next 5 years. So out of the 523 billion, about $300 billion is coming from OpenAI. Now you might be saying, what is wrong with that? OpenAI is the leader in AI. They just went on an equity raise at $500 billion. They want to do $1 trillion IPO and Sam Altman, and they're launching ads and they're doing all these things. So what is wrong with OpenAI contributing $300 billion? Well, I talked about this recently, but I think there's a massive risk to OpenAI that hasn't existed before. And a lot of companies are kind of dependent on OpenAI succeeding, on OpenAI becoming profitable, on OpenAI maintaining its leadership position as a generative AI space. And if it doesn't, if it cannot pay, if it cannot raise money at the right valuation because it's not profitable and it's not going to be anytime soon, Oracle is not going to get their $300 billion, and AMD is not going to get some of their obligations, and a lot of companies could potentially be in trouble. And the reason why I'm talking about this is because I believe we have a change, or a sea change, you could say, in the whole AI race, and this is Gemini. Gemini has been killing OpenAI over the last few weeks. It has been taking market share like never before. It's a serious competitor, and a lot of people I know that use Gemini had never gone back to OpenAI or ChatGPT or whatever you want to call it. So this is a major risk. But the major difference between the two is that Gemini does not have to raise money to fund itself. It's funded by the parent company, which is Alphabet. So if OpenAI is desperate for money and they put an ad on their platform, Gemini is going to give it to you for free, and people will go to Gemini. If OpenAI wants to give you their best model for a certain price, $20 a month or $30 a month, Gemini will give you their best model for free. So it's very hard for OpenAI to win. And if the market realizes that, and if Gemini keeps on catching up, Oracle, or I should say OpenAI, may not have $1 trillion IPO. They may not be able to raise money at a $500 billion valuation. They may not be able to benefit a lot from ads and premium products because people don't want to pay, and Gemini can afford making people not pay for their product. So if that happens, Oracle is not going to get its $300 billion. And I think this is a big risk. But the major risk with Oracle is the balance sheet. The company has about $127 billion in debt. They have $99 billion in long-term debt. They have $8 billion in short-term debt and about $20 billion in other long-term liabilities, which is also debt. And against this $127 billion, they have about $19.7 billion in cash and cash equivalent, which is pretty much nothing. Now, on this debt obligation, the company is paying about $3.8 billion annually in interest expense, just in interest. So the debt situation is getting a little bit out of hand. And by the way, I'm using fiscal.ai to come up with all those charts. If you want to try it out, they give you 2 weeks of free access if you use my link into the description. But anytime I have a company with a massive debt obligation and just a bad position in general, I mainly go to the annual report and I try to look for the maturities. And I want to know if they have any near-term maturities that could potentially put the company into trouble. And I also want to know how much in interest are they paying on those loans. So if I look at the interest profile, or I should say the debt profile of Oracle, and I'm seeing out 5.8% interest is due in 2025, 1.6%, 2.6, 2.8. So most of their loans are actually at low single-digit rates, 3%, 2%, maybe 5%, 6% is the most. And nothing is really due anytime soon. They have 7.3 billion due in 2026, 5.7 in 2027, 10 billion in 2028, 2 billion in 2029, 7.2 billion in 2030, and after 2030, they have the $60 billion due all the way up to 2052. So they have nothing major anytime soon. They're well spread out, and this is really, really amazing. Now, the next step to analyze if the company can even pay their debt obligations, we have to look at the free cash flow. So we take the free cash flow and we see how much the company is paying in dividends, and we get the net free cash flow. And this is the free cash flow left for the company to be able to pay down the debt. And we want to make sure that it's generating enough cash flow for the company to pay down its debt. It's fair, right? Now, if we look at Oracle, Oracle is free cash flow negative. It's crazy. They're losing $13 billion in free cash flow. 2026 is expected to be a negative $9.7 billion free cash flow year for Oracle. 2027, it gets worse, $11.7 billion. And I've seen some reports that Oracle will not be free cash flow positive before 2029 to 2030. So the company has $127 billion in debt obligations in general. They have $25 billion due over the next 3 years, but the company is also losing about $10-11 billion every single year that will likely be added to the debt position, and they're going to have to take on more debt to fund their debt and fund their obligations. And they're taking a lot of risks, guys. Like, I love when companies want to expand, when they have ambition, when they want to grow, but this is getting too extreme. And I've seen many companies that took on a lot of leverage, did a lot of crazy things, even when the funeral home companies were consolidating with leverage. And leverage ultimately could lead to a lot of bad things. And even though Oracle is an amazing company and they have Larry Ellison and all these things, we can't pretend like this is not a risk. And I talked about it on X, and people shrugged it up. They say, yeah, whatever, the company is trying to grow. Yes, the company is trying to grow. You can clearly see it over here, where the company has about $26 billion in cash from operations. They're spending on CapEx $35 billion. 2027, they expect to make $35 billion in cash from operations. They're spending $45 billion on CapEx. And most of it is not maintenance CapEx, it's gross CapEx for the company to grow. So once they put up the CapEx, they're going to ultimately reap the free cash flow benefits. But that's not going to be here before maybe 2029, 2030. And there's nothing wrong with that if the company at least has a good balance sheet. But with $127 billion in debt, I don't think the company is in a good position in general for them to do that. And I think they're taking a lot of risk. And I think something could happen, especially if something happened with OpenAI, God forbid, and I think there's a lot of risk with that in general. Now, if we look at the company's multiple, it's trading at 22 times price to operating cash flow. This is really not expensive at all. But as the company has a lot of debt, we're going to use enterprise value. If we use enterprise value to operating cash flow, it trades about 26 times. 26 times, guys, I'm being honest again, is really not too expensive for a company that's expected to massively ramp up operating cash flow growth, 28% in 2026, 31% in 2027, and up to 51% in 2028, paying 26 times for a good founder and a good CEO and just a good company is really not expensive. So it's hard for me to be extremely bearish on Oracle. I think the stock could play out. I don't think it's a bad buying opportunity, but I was just trying to highlight the risks. I think it's, you could say, fairly valued. I think the stock could surprise a lot of people if nothing happens, if everything goes perfectly. But if something goes wrong, Oracle is in a very vulnerable position. and they will likely be in trouble, which is why I would say that it is not a bad buying opportunity. But if it was me, I would not put in a large percentage of my portfolio in Oracle. I would put in a small percentage and monitor the situation, see what happens. And if things are getting better, maybe the company is getting less aggressive, they're focusing a little bit more on mitigating losses, then maybe I would add to the position. But I would not believe that Oracle is some kind of a safe company that can never go under, nothing could happen to it because of whatever reason. I think there's a major risk, and I would like to account for the risk with the right position sizing. And that's just my opinion on Oracle. It was not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.